Hello, it's Abdurrahman Ali here, and we're gonna talk today about the continuum of the transfer pricing concept. So here we're gonna follow along with the OECD Model Tax Convention again. The Model Tax Convention is short for MTC. If we go to the Article 7 of the Model Tax Convention, it's speaking about or it's referring to the business profits. Business profits are dealt with usually if we read through the first paragraph. It's the profits of an enterprise of a contracting state shall be taxable only in that state. So this is the tax jurisdiction to tax, and this is the right to tax rule. Unless, and this is the condition, unless the enterprise is carries on business, perhaps it's dealing some business in the other contracting state through a PE, permit establishment, therein. If the enterprise carries on business as said, the profits are that are attributable to the PE, which is the permit establishment, may be taxed in the other state. So this means that if you are operating in country A and you have a permit establishment, and we're gonna talk about what could be a permit establishment in another episode. But if you have another enterprise, let's call it small business enterprise or permit establishment, at that time only the other jurisdiction or the other contracting state may have the right to tax the PE profits that is attributable to that PE. If we think about the second paragraph, it says, for the purpose of this article, business profits. Article number 23A and 23B, which is basically referring to the elimination or relief from double taxation by credit method or exemption method. We will talk about it in a later chapter, but those are the two main ways or mechanisms to relieve from double taxation. Double taxation means in very small essence and instance is the profits is being taxed twice. So the profits that are attributable in each contracting state to the PE or the permit establishment as referred in paragraph 1 are the profits it might be expected to make, in particular in its dealings with the other parts of the enterprise. If it were a separate and independent enterprise, this is the definition of what could be a PE dealings at arm's length. It's dealing if it were a separate and independent entity approach. Keep this in mind. So enterprise engaged in the same or similar activities under the same or similar conditions. So same conditions, same activities. And we shall take into account the functions performed, assets used, and risks assumed by the enterprise through the permanent establishment and through the other parts of the enterprise. This is the rule for the attribution of profits to a PE. That you think about it, that it is a separate, independent entity dealing at arm's length, dealing under no control, and if it were independent party. In the third paragraph, they are reflecting how could be an adjustment happens, where in accordance with paragraph 2, a contracting state adjusts the profits that are attributable to a PE of an enterprise of one of the contracting states and taxes it accordingly. Right, it would be subject to tax in the other state. of the enterprise that have been charged to tax in the other state. The other state shall, to the extent necessary to eliminate double taxation on these profits, make an appropriate adjustment to the amount of tax charged on those profits. This is the rule of there should be no double taxation on such profits. If there was some adjustments happen to the PE contracting state. In determining such adjustment, the competent authorities of the contracting states shall, if necessary, consult each other. This is the same exact sentence under Article 9, Associated Enterprise, in the other video. So the model convention is asking and endeavor that the competent authorities of the two countries or two jurisdictions to consult each other for the relief of the double taxation that caused after the adjustment. In paragraph 4, it's referring to where profits include items of income. Any items of income which are dealt with separate in other article. So this paragraph in particular is not really relating to transfer pricing, but we need to think about the first 3 paragraphs of the article number 7. It's talking about and it's referring to the relationship that could be attributed between two associated enterprises. One is one party in a contracting state A, for example, and the other is a permanent establishment in the other contracting state. So the dealing between each companies should be dealt as at arm's length, which is the fair market value, and if it was independent entity, how would the attribution of profit happen to it? It should be based on the functions performed, assets used, and risks assumed, and that's a way long point that is pointing out to the functional profile or the function analysis that you should be exploring and applying to get how to attribute the profits to that PE without any arm's length or non-arm's length principle not being applied. So stay tuned. We're going to talk about it in very simple terms about the transfer pricing topic. And it was Abdurrahman with you. Pleasure, and see you soon in another new episode. Thanks.